Hello, ladies and gentlemen. Welcome to Triple N Media. I am NIK NIKAM. This is a stock market update. The topic of focus today is Hedge Fund 101. You might have heard of hedge fund names like Melvin Capital, Citadel, with reference to GameStop, Short Squeeze, Wall Street Millennials, Robinhood, Reddit. What does all that mean? Well, I'm going to unravel the mystery about all these connections and see what we can learn from this as individual investors. Going forwards, most of us will be individual investors, not relying so much on brokers to buy and sell stocks for us. But when we do the stock trading ourselves, we need to understand the market very well. We need to know when to get into the market, when to get out, and how to hedge our long positions with things like puts, covered calls, or ultra short derivatives, so that you minimize your risk. That's where we get some important lessons from hedge fund managers' approach to dealing with funds. So let's learn something about hedge funds, and hopefully that will help us to become a more informed investor. Hedge funds have gotten a lot of bad rap, but actually hedge funds are consistently returning the highest return for investment for their individual partners or people taking part in their funds. By definition, hedge fund is a form of a private mutual fund that is involved in an aggressively managed portfolio of short, long stocks, options, real estate, you name it. They will invest in anything that can make money. They can be long, short, or have complex formulas to minimize the downside risk. They also use leverage of margin and collaterals. Hedge funds, unlike mutual funds, are a private company and they are not regulated by the Securities Exchange Commission. They do not need to disclose their profits and losses or file reports with the SEC. They are not bound by many stipulations the normal mutual funds or ETFs have to deal with. They consistently return much higher profits for their investors compared to a regular return in a stock market. What are some of the principles used by hedge fund managers? And this is something we need to look at it from a pragmatic point of view so that we can use this to improvise our returns, minimize our risk, but not being as aggressive as the hedge fund managers are. Most of the hedge fund managers are real good people. They work with billions and maybe trillions of dollars and try to maximize return for their investors. Their investment goal is to maximize profit, not to sit on a stock for 10 years or 20 years, and when the market drops like 40% as it did in March 2020, they're going to sit there and cry or try to wait for the market to come back. Well, luckily it came back, but in the meantime, they will know how to maximize return while the market is going down, while the market is going up. So they are market neutrality. They don't care which way the market is going. That's why I'm saying we need to learn some lessons from the hedge fund managers' approaches so that whether the market is going down or going up, we need to be protecting our assets the best way we can. They use leverage and they invest in risky entities. That's something we don't need to take it to our personal accounts. The other thing about hedge fund is it is limited to wealthy people. And I'll tell you what criteria we need to get into this particular entity. As I said, consistently return much higher profits. They manage, as I told you, trillions of dollars worth of investments for governments, for institutions, for retirement funds. So they are a legitimate institution. Since they use leverage, since they use collaterals, since they invest in risky instruments, they are liable for heavy losses, as we saw with the GME short squeeze, where Some of these hedge funds lost $2 to $3 billion, maybe a tune of $5 billion in a matter of just few days. So things can happen. Lightning can strike to anybody at any time. Hedge fund manager is known as a general manager. It is managed by a general manager. He is the brain behind that $100 billion or $1 trillion fund. He gets 1 to 2% of the total assets as his salary, along with 20% of the profits as his commission. Some hedge fund managers make billions in compensation. You want to become a hedge fund manager? I'll tell you what you need to do. Let's look at some of the pros and cons. Profits rise in a rising or falling markets. Regular mutual funds, they can't trade both ways aggressively because hedge fund managers have a balanced portfolio, positive and negative. They can minimize their risk. Several investment styles they can choose from, and it is of course managed by some of the brightest brains in the financial industry. What are some of the cons? Losses can be potential because they are involved in risky investments. They have less liquidity than standard mutual funds. They lock up investors for an extended period of time. Because they use collateral and margin, they are liable for much bigger losses. I'm talking millions and millions of dollars. Some of the disadvantages of hedge funds, which is pretty obvious, they could lose huge sums of money. They are less liquid compared to mutual funds. And as I said, the investors have to lock in their money for extended periods of time. They just can't get in and out as you can do with like a ETF. The downward risk is always there. So you want to invest in a hedge fund. No problem. You just have to be an accredited investor. Let me repeat it. You just have to be an accredited investor. What does an accredited investor mean? It's very simple. You need to have $1 million in total assets in your portfolio. Then you have to have $200,000 or more revenue, income in the past 2 years. You need 2 tax returns and a statement from your bank saying you got $1 million. That's the ticket to get into a hedge fund. But that's just only for the entry level hedge fund. I mean, if you're talking about something like a big Bridgewater or something, they may require you to have billions of dollars in assets before they can open the door for. Carl Icahn manages a private hedge fund. He also has a public fund which sort of parallels his philosophy, which people can invest in. So that's one of the names. The first hedge fund was started by Alfred Winslow in 1949. Maybe some of you are not even born in 1949. He invested $100,000, $40,000 of his own money, and he used the principles of going long on stocks, then going short on stocks, selling calls, buying puts, multiple combinations to minimize the downward risk when the stock market is going down and maximize profits in the meantime. He changed the concept of his company from a general partner to limited partner. That means only people with invitation can come and join the company. And then he added 20% incentive to the general manager, the man with the brain who runs this hedge fund. He gets 20% of the profits. If in 1 year, if they make $100 million profit from $1 billion investment, that out of $100 million, he will get 20%. That means 20% of that, he will get $20 million in addition to 1 or 2% of the $1 billion total assets. You do the math. Today, hedge fund is a very large industry to a tune of $3.25 trillion according to the 2019 Preqin Global Hedge Fund Report. Today, there are more than 10,000 hedge funds in the United States according to 2019. If they usually do not advertise on television, radio, or any other media, mostly word of mouth and by invitation. But if they have to advertise publicly, they have to file Form D with the Securities Exchange Commission. And here is a list of the world's top 10 hedge firms. Bridgewater is one of the biggest known names. I'm going to come back to that. Then we have Renaissance, Mann's Group. Then we have Sigma, Millennium. We heard about BlackRock involved in the GME short squeeze story. Citadel is another one. Bridgewater Associates. If you want to learn the techniques used by hedge fund managers, you need to study the hedge fund managers and listen to their presentations on YouTube and see what kind of things they do. Not that you want to be a hedge fund manager, not that you want to be a super aggressive investor, but you want to use some of their hedge principles to minimize your downside risk. Ray Dalio is the most celebrated hedge fund manager in the United States. He started his hedge fund in 1975 in a 2-bedroom basement apartment and has grown that into multi-billion-dollar hedge fund, consistently returning good profits far above what the stock market is able to deliver. He has 4 different companies here, and as of April 30, 2020, he was managing $138 billion. $138 billion times 2%. That itself is his salary. That is almost like $2.8 billion. So, plus 20% of the profits. Anyway, you have heard of the term Citadel with reference to GME's short squeeze that was in the news. And in fact, these people were called to a Senate hearing. Citadel advisor is Ken Griffin, who, when he was 19 years old, started trading stocks from Harvard Dormitory. And he started this Citadel Capital Revenue. His compensation was $870 million in 2018. And he has been a very successful investment capital, managing $29 billion of assets. What do you think? Well, it doesn't matter how much money you make. It doesn't matter how much time you invest in your profession. You still have to go through the cycles of life. In fact, this is a picture of Ken Griffin settling his divorce from his wife. Put that just to give you a context that yes, money is important, but family and peace of mind are equally or more important than any money. And here is a real chart of, this is TQQQ, but it's a NASDAQ proxy. And when the market dropped in March 2020 by 40%, how did you protect your long-term assets? Did you know how to minimize your losses? Luckily, the market came back within a year, but there were times when the market just went sideways for 3 years, 5 years, 8 years. So how would you deal with those conditions? That's the purpose why I'm presenting this Hedge Fund 101 lesson, which we can use. And in conclusion, I want to say, how can we use some of the smartest techniques used by hedge fund managers in times of crisis, in times when market crashes? In fact, many experts are predicting the market is going to crash this year and may reach lows below that what we saw in March 2020. If that is going to happen, how are you going to be protecting your assets? Now let's think like a hedge fund manager and see how we can use some of the safer methods to protect our assets. One, we need to be aware of the fact there are what is called ultra funds. For example, NASDAQ QQQ, you have that goes up. And there are ultra or ultra pro ETFs like SQQ, or for SPDR we have SLD, which go up in price when the stock is going down. So if you're long on QQQ, then you should look at some of these ultra pro or ultra short ETFs and buy some of those so you protect your, minimize your loss. You can also do that with covered calls, or you can buy puts. You can diversify your investments. Risk only money that you can live without. I mean, that is the principle number one. As I said, peace of mind is worth more than any money you have in the bank because you can't take it with you. Family first. I hope this has been educational and useful to you. Certainly, I have learned a lot from watching hedge fund managers, and I do aggressively use mechanisms to protect my downward loss. See you in the next video. And please do subscribe to our channel, and see you next time.